Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Shelby McFaddin. How you doing, Shelby?
I'm doing well. Thanks, Kirk.
Great, great. Well, glad to have you in the show. Before we kind of dive right in, tell us a bit about your background, how you get into this field.
Absolutely. So I started off as an economics major at George Washington University, ended up finishing there also with an international affairs degree and settled myself down in Northern Virginia, as most of us do. Started off working with an OCIO, outsourced chief investment office in Roslyn, Virginia. And there I worked on private equity and real estate portfolios, where we were essentially managing just that asset class for institutional clients. About a year and a half in, I shifted over to public equity, so doing the same thing, but specifically for public equity there. I was served as a senior analyst there for about a year and a half. And then I decided to go ahead and make the transition to really being a stock picker. So no longer just running the attribution on how well our managers were doing, but wanting to actually get into the weeds myself. So that's when I made the jump over to Motley Fool Asset Management. That's about 2021, March of 2021. And I've been here ever since. My day to day is going to be regular coverage, finding new names for the portfolio, sitting through those earnings calls and reading proxies. But then I also get to spend some time here being able to represent the firm and getting to talk stocks and economics all day, which is one of my favorite things.
Nice. So you do more of the stock side than like the macro portfolio side. Is that correct?
Yes.
Okay.
So I would be more of a macro person out of all the people on my team. But yeah, my official day job is stock picker.
Okay. Do you have certain areas that you like, certain sectors you focus on, or you just kind of like everywhere?
So I am a bit of a generalist, but I would say that I'm not, I really like to focus, but a lot of my coverage is in retail and consumer exposed names. And that really just comes from my interest in human behavior, which underpins so much of economics. And also because when we think about the financial markets, they don't exist in this vacuum away from what's going on in the macro sphere. We've seen it plenty of times over the past 18 to 24 months where we get a macro report, we saw it happen today and it impacts what's going on there because it impacts all of our models. So I tend to be really interested in that because you get those direct inputs.
Yeah, I mean, how have you seen, so the public side's kind of interesting. How have you seen that change? I know in the last 25 years, I've seen it change a lot in terms of what works, what doesn't work. Um, but I'm curious on your opinion because the markets used to be a little bit more, um, I guess you could be a stock picker easier, like
Mm-hmm.
20 years ago, and now it seems to be a lot harder unless you're picking the seven biggest stocks. Like you're kind of you're kind of at a disadvantage. So how are you finding that environment in picking stocks right now?
Yeah, I would absolutely agree that as we increase the breadth, it gets harder to beat the market. But luckily, I'm not a quitter. So what we continue to do is just stay the course on the strategy, which is staying on our four pillars of quality. And so it's going to take some time. And in markets like this, like you pointed out, it can be really difficult when you have a lower allocation to one of those seven stocks or really you're just not necessarily riding the AI wave, or the mandate on your portfolio is not large cap growth. But if you're staying the course and you're looking over the long term, the truth of the matter is that cash flow is going to win, right? It may not necessarily be the fundamental that's or the fundamental that's in for the market. It may not necessarily be getting the pricing premium at the time. But when push comes to shove, a company that's cranking out cash is where you want to be when the macros are really starting to knock you down.
Do you consider yourself more of a value focus or a growth or somewhere in between, or how do you characterize yourself?
I think I'm somewhere in between. And I would say that because if I do see something I like, and if it appears to be a little bit rich, I'm not necessarily just going to put it down. So there's a company that I've been looking at for a bit. I've been running some of its multiples against their peers and having a look, and I'm saying, all right, this is pretty expensive. But I'm not necessarily just going to throw it away. I'm going to sit and maybe wait for it to get a little bit more attractive. But also would not go ahead and say that I'm only looking at things that are deeply discounted. If anything, I might even have a little bit more caution over things that are deeply discounted, especially in this market where, for the most part, the broad swath of the market is trading at some degree of a premium. So I would even say I'm a little bit cautious against leaning too hard on value, but I do consider valuation more than I would say the average growth investor would be thinking about when we're thinking about the market.
So would you say you fit more into like a GARP kind of model? Um,
Yes.
okay. And if the listeners don't know, that's growth at a reasonable price. I know it's not talked about that much. Nobody advertises, but yeah.
No.
Okay. Um, so how do you come to terms? You mentioned this a little bit. How do you come to terms with the fact that value has basically been out of favor for the last 25 years? There's been like a year or two where it was okay, but I'm a value guy. That's how I
Hmm.
think about the world, but yet I don't have that as a strategy because it's been out of favor. And
Hmm.
people won't work with you if you're underperforming the index every single year and it's not,
Yep.
nothing you can do about it. But how do you kind of square that? Because by many metrics, we're one of, if not the most expensive markets we've been in.
Yep.
And yet we're still trying to pick stocks, we're still trying to grow portfolios. Like, how do you operate in an environment like this and, not be freaking out?
Yeah, I think the what we've had to do a little bit more of is looking at, if let's say we have a given company, taking a look at one of their biggest competitors or their biggest peers. I think it gets a little bit easier if we're looking at an industry that's got three big players. And we look and see how they're trading. And we say, well, this is terrible. This is incredibly rich and it doesn't seem reasonable, but it's the environment that we're in. And so if we're going to make this bet, then we have to say, all right, man, 35 times free cash, don't love it, but apparently this is what the industry is going for. So if we're then looking at, okay, well, this is trading at about 28, then maybe that's something where we say, oh, this is a bit of a discount. It's not a discount to history, it's a premium to history, but it's a discount compared to where they are with their peers. And then when we want to kind of look at history, if we see something that is just completely unreasonable, it might just stay in the universe, right? It might not be something that actually makes it into the portfolio yet because there's nothing that could rationalize that valuation. Then, when it comes to how do we play to some of those baser value instincts, sometimes that might end up in the dividend portfolio. Now, the dividend model portfolio is not a value portfolio, but you're more likely to find stocks in a value index in that portfolio, mainly just because when we're combining both the dividend yield and then also the total shareholder return that's going to come from buybacks, you're going to get a better yield out of companies that have a consistent dividend and they're also trading at a discount, right? We know that. So that is where we sometimes can play to those. This is actually a safe value play. It's a consistent name. It's not anything new that just looks sort of unappreciated or sorry, unproven. It's just a little unappreciated. That's where you might start to see that. So we give ourselves a little bit of room to look at some of those traditionally mature companies and have them in the portfolio, and then get the opportunity to benefit when there's something in the macro environment that gives them a little bit of a makes them look a little bit growthy in the market.
Are you familiar with the shareholder yield model? I know Meb Faber talks about it, but somebody else originated it,
I
where it's
wonder if I am, but not by that name. Go ahead
it, it's
and give a
basically
summary.
companies that have dividends and ideally increasing dividends. It's all about cash flow. They're buying back
Mm-hmm.
shares, they're paying down debt, basically all positive things,
Mm-hmm.
and it's more of a model of companies being responsible with their cash flow, and it tends to also be aligned with companies that are owner operated. Um,
Yep.
so I don't know what kind of things you look for, but it sounds like you're similar. But what have you found to be the biggest levers in success with stocks that you've invested in?
I would say for me, it really does come down to the quality of the operator. And that's actually a discussion I had with someone on the team earlier this week. When we look at what's coming down the income statement, it not only is impacted by just what's going on with the industry, but by the decisions that these operators are making regularly. So that could be something like if they decided that they're going down market, that's a concrete decision that they've made. They have started to direct SKUs at a place that is outside of, let's say, their sort of premium cash, and it will affect the results. And so when we want to have a look at companies that are going to be a bit more resilient, it really does start with the operator because you can have two companies in an industry. I mean, we've seen it with, let's say, Walmart and Target, just a really general example. The strategies there and the two different operators have sent them on vastly different paths. Now, they are fairly different stores, but Target has had opportunity to try and change parts of its strategy, right? And the operators there have made different decisions. So you can see that sort of come down the income statement and the cash flow statement as well. So that's something that is really important to me when I'm having a look at companies. Another example of that I would probably say would be like UPS. That's a favorite company of mine. I own it in my own portfolio. We own it in a couple portfolios. And they have made over the past probably 4 years some pretty big decisions about choosing the sort of quality over volume and trying to lock down customers where they're going to be able to get price security and loyalty in those contracts. And that's made a huge difference over their profitability. And it's meant risks, but they have definitely been tough. And they've kept their eyes on the long game for that business. So I think that's something that definitely stands up to the macro tribulation in the market, but also to different sort of quakes that can hit a specific industry as having a strong operator.
Nice. Where do you where do you see opportunities right now in the economic landscape? With everything being really expensive, like are there certain sectors, certain areas that you see as we can get into I mean, we just had obviously presidential election and new administration, new ideas, but in general, where do you see opportunities just from a pricing valuation standpoint?
One of the things we're looking at right now as a team, looking at a little bit more closely, is certain industrials. And part of that is because the global energy landscape is just getting shaken up a bit, right? Energy and materials. In the United States, we have a constant need to be updating roads and bridges. There's a pothole in my own neighborhood that I remember when it got patched, and I said, great. Then we got a snowstorm, and I said, that patch has got 10 days to live, and it's already a pothole again. So, we know there's a constant need for that type of upkeep here. We have bridges that need a lot of taking care of. And then, more importantly, potentially, we have a massive housing shortage, whether it's single family or multifamily. So, there's a lot of infrastructure that needs undergoing in the United States. And yes, we are aware of the fact that the interest rate environment, as well as the potential import export environment, could make that a little bit more hostile to these manufacturers and to these construction companies. But it is also still just a supply demand level need that has to be fulfilled over, the next 5 to 10 years in the United States. So we've been having a little bit of a look at that because those are companies that when you first mention that, someone says, what on earth? Why would you want to be involved in materials in a time like this? And it's because the sort of underlying need is still there. And so we take a look at it at exactly this time when it might be a little bit unfavorable. And we say the company is run well. The market just doesn't appreciate it right now. Let's potentially open up a small position here.
Yeah. Okay. Obviously we have the new administration, new policies. Where do you see economically and opportunities wise, where do you see that going?
I think economically, and this is something we also considered before the change of the administration, is we expect there to just be a higher price level in the United States for longer than originally anticipated. And I think we sort of see that as well in how Chair Powell has testified in the decisions that he's made on holding rates. It's just been sticky. We went from transient to sticky in a period of 2, 3 years. And we are not expecting the price level to sort of make a general decline anytime soon. Some of the new prerogatives of the administration are going to be a little bit in conflict. It'll be interesting to see the sort of net result that we get. Just some of the reduction in government, what is it? The amount that government's contributing to GDP. Does that savings end up helping the macro landscape? Is it offset by any other sorts of prerogatives? It's really difficult to sort of see the net result of that at this time. But I think the one thing we're holding on to is we are not expecting a softening in the interest rate environment anytime soon. And we expect prices in general to remain elevated. So windfalls are less likely to come from a changing interest rate regime as opposed to just changes in the production environment. So if you want to look at steel, then sure, domestic steel producers, they had a little bit of a pop because If there's less coming in, then they do better for themselves. But if you travel downstream, it gets a little bit tougher. Prices are going to stay elevated. Still need to build those houses. They're just more expensive to build. So I think inflation staying elevated is probably the one core expectation that we had before the change of the administration. And then also, we're just not necessarily seeing anything that is telling us, yeah, that's definitely going to bring prices down. Not yet. We're not seeing that yet.
Yeah, I tend to agree. I mean, we've talked about that a lot in the show. Like, I wonder, um, when Powell dropped interest rates 100 basis points for the election, which I thought was, I still think somewhat politically motivated, but
Agreed.
they dropped 100 basis points. The bond market went up 100 basis points. The bond market tended to disagree with that
Yeah.
decision. Um, but I found that interesting because I'm in total agreement. We should have been five and a quarter, five and a half, somewhere in that range. We should have just stuck there. I think that's a good
Yes.
range. Um, and I agree. I think inflation will be sticky. I think the thing that I wonder is, Trump's a real estate guy. He likes low
Mm-hmm.
rates. And I could see him putting pressure on the Fed to lower rates. I'm not sure that's a good thing. Um, but I do wonder, I'm curious of your opinions because the housing market has been one area that's totally confused me.
Mm-hmm.
I look at things as supply and demand, interest rates, low rates, more, higher prices, higher rates, lower prices, but yet we didn't have lower prices when rates
Nope.
went up. We had higher prices as if people didn't care. However, we have a frozen housing market because
Yeah.
rates went up so much that effectively you're paying double for the same
Mm-hmm.
house.
Mm-hmm.
Your payments have doubled.
Yep.
So you could buy. So if somebody wants to downsize to half the house, why would they? Because you're gonna have the same payment, so you might as well just stay in the same house. And so the housing
Yep.
market's frozen. And so I wonder what is actually going to cause that to unfreeze? Because around here, and you're in Northern Virginia, you're probably similar economically
Yep.
in Boston. Like, there's a lot of expensive houses here. People have money.
Mm-hmm.
Boston's a pretty diverse city, diverse economically, and getting plenty of government money and all that. So I don't see house prices going down, but I also don't see people moving all that readily. So, what do you think is going to change that? Like, what's going to have to happen? Because in Boston, they can't really build a bunch of new houses. They can, but
No.
way out there. So, you're not solving the problem. So, how does this get solved?
So I think there's a few different approaches to that, and I wouldn't necessarily weight my confidence on anyone in any particular way. One of them is rezoning, and that's something that has definitely hit Northern Virginia. There's a lot of clashing over what do we do? Should we change the use of this building so that we can go ahead and have more multifamily because we don't have the room or we can't afford to construct a bunch of single family, right? We can't seem to attract the home builders, so what about if we go for the commercial real estate, right? So you have rezoning, but a lot of times that gets shot down. Then you have rates, and we're both in agreement about the fact that they probably should have stayed where they were, because we're now seeing the effects of those rates potentially having come down too early. And so if we go ahead and assume that that's not happening anytime soon, the next thing that you would have to look at is something coming from municipalities or from states that indicates, okay, listen, we are going to try and attract these home builders somehow. But then we have to ask ourselves, well, where's that money come from, right? So it's either zoning rates or you attract the home builders to build in an environment where it's expensive for them. So they've already been buying down mortgages, right? And that is absolutely that's draining on their coffers. And so there's only so much of that that they want to do. And then there's also the fact that the middle of America doesn't necessarily want to be developed. So as we're moving off of the East Coast, figuring out where to continue to put all of this housing, it's not as easy as it was a couple of 100 years ago to just start plopping down settlements. So, to your point of folks wanting to just stay in their homes because the interest rate on my house is the mortgage on someone else's house, like my interest payment, things like that. The rates continue to go up. And yeah, folks raise their price because they're saying, if I need to leave my 3% mortgage, I need in equity the amount that I'm going to have to essentially throw away on a monthly basis or for interest, or so that I can just port that equity to another down payment so that I'm not getting hit so badly with interest. So you're exactly right that it's not doing what we would expect it to do, because the situation that people find themselves in sort of breaks the basic economic model. And it's interesting that we were talking about tariffs because that's a little bit what the graph would look like, right? If we think of extremely low interest rates as sort of a subsidy, it's changing the standard supply and demand dynamic, where now the incentive you need to give someone to move along the supply curve normally, they're not willing to do it, not without a subsidy. And so that increase in housing prices is just saying, I need more equity to subsidize this decision. And so, yeah, I think there's that sort of three forked road of how we get this done. And I think the unfortunate answer is it's going to take some time, and it might take more government than people are interested in. Because if the Fed stays where it needs to stay, then rates are not what's going to do it.
Yeah, it makes me wonder if low rates are going to help unfreeze the housing market and cause people to buy and sell more. But I don't know. Like I said, I've been wrong on the housing market because I thought it was rate sensitive. It used to be,
It used to be.
but, of course, the stock market used to be based on fundamentals, and now no
Yep.
longer is. So.
Just AI now.
Yeah, yeah, it makes me wonder. What are your thoughts on AI? Where do you think that's going? What do you think the impacts are going to be?
Yeah, I do think it can be a valuable tool, right? We had a meeting earlier today about trying to find more ways to work agents into our work to sort of get through some of the grunt work faster, right? Not to do anything that would put our clients at risk, but to figure out, okay, what are some of the major changes in these two filings, and then go have a look at it, things like that. Where can we shave off 5 minutes, right? But when I think about the impact that it's having on companies that in some cases are very loosely related to the capital expenditure that's being put down by some of the hyperscalers, that's where you lose me. So we are in a point where we started to see that investors were saying, hey, you need to show me what all this is going to be. We're starting to see that companies are not getting to just fly under the radar when they don't deliver on cloud or they don't deliver on data center, but they're not getting chopped 20%, right? And there's an argument that some of them should. They're getting hit by 5%, 7%. And we're calling that, oh, they're getting absolutely tanked. And it's like, I don't think so. 7% off of something that was already a little, or not a little bit, completely unbacked in fundamentals and largely just riding on more than expectations. We're talking about aspirations now. We don't love it. We would love to see a return to breadth in the market because there's so many more tangible things that companies are doing well. If we want to sort of break down that circumstance, we look at Apple, and everyone's always, why won't they just catch up? They're not doing enough on AI. Yeah, but they're doing pretty well in what they do. China's a little bit difficult, and China's been difficult for pretty much any company that is manufacturing a consumer product, whether it's just a CPG good like Band-Aids or if it's iPhones. If it's perfumes, even, it's just been difficult, right? We know that. But for the most part, they're not having issues with people leaving the iPhone, right? With leaving Mac to go back to a PC, things are pretty sticky. So it just is a matter of, okay, they're a pretty mature company and they decide to go with these developments and innovations at their pace as they see fit for their own profitability. And yet they get punished for it. So it's an interesting dynamic to see what happens when your pricing is built more on these really, really intangible aspirations. And that gets rewarded by the market as opposed to what you've been able to do. But when you disappoint on those aspirations, you get punished pretty quickly.
I feel like Apple's one of those companies. I think it was about 10 years ago. It was like 2012, 2013. It went from a growth stock to a value stock. And we had all this big rotation at that time. And there was a big sell off. And then it seems to be fine now.
Mm-hmm.
But I look at a company like Apple that always just dominated. And now they seem like they become IBM. Like they're,
Yeah,
like the
they
old
cruise.
IBM, everyone was great, loved them. And then they just kind of like just static. They're not really growing. They don't have new ideas. The new ideas just don't work. They're doing
Mm-hmm.
the automation, auto drive. They were getting to that. They submarine that project. It seems like they're not coming up with anything new, and the updates are kind of like, why do I want to spend another $1,000 on a phone when you haven't really changed it? And to me, it seems like they don't have any good new ideas. It seems like they're behind the ball on all of them. Even the AI stuff, they're like, oh yeah, we're going to get into that like 2 years
Mm-hmm.
after. So To me, I wonder, but people still buy it. People still have it in there, and it's still a large company. But it makes me wonder, how much innovation is actually happening there. And you look at the other companies, like I take just somewhat of a negative view on some of these, but I'll hit on them all. I mean, Tesla is basically an auto company masking as a technology company, but it's
Correct.
a really expensive auto company. It's so far expensive, it's ridiculous. I don't get that model. You've got Facebook, which it's basically an ad platform that's going to die a
Yep.
slow death.
Hmm.
AI is going to totally kill their model. It's gotten a lot worse since they disconnected from Apple and their data. And I just, they're trying to innovate, but I just don't see them pivoting to. I don't see the Oculus taking over. I think they're
Yep.
way too early on that. So, I look at that and say, all right, where's the growth going there? You look at Amazon and say that's great, but where's the growth there? And
Hmm.
so I kind of take all these companies. I love Microsoft. I think they're one of the best.
We're fans of Microsoft. Yep.
Yeah, one of the best companies out there, in my opinion. But and of course, it's not financial advice. I got to give that disclaimer.
Disclaimer,
Just,
disclaimer.
but I look at this and I say, well, we have an economy that's basically driven. You have Nvidia, which I mean, what's the PE like 5,000? Like it's
It's
crazy.
gotta be.
Yeah, I mean, it's nuts. But so you look at all these companies and say, well, we've had this massive growth. Is this going to continue?
Hmm.
It feels like 99 where what Cisco still hasn't achieved the price it hit in 99, just like 25 years later. So I wonder, where we're going to go from here. Is there still opportunity for the US to grow? Because was it 40% of the index is made up of like seven stocks, and
Yep.
um, that has an impact on the growth of the index. And then you've got international, which has been largely lackluster in Europe. China's
Hmm.
going through a refresh. Who knows where that goes? And so it just kind of makes me wonder, like, where are the opportunities in equity prices that are not overly risky? Now, do you guys look at international, or are you just mainly domestic?
We do look at international. Our some of our products are US only mandate in terms of active, but some of them do allow us to have some international, and then we do have an international model portfolio that we manage for the our sister business. That's a wealth business, so that is real money. We just have to, just call it a model portfolio. But yes, we do dabble in some international, and I think you have a great point that it's been lackluster there. It's a great time for trying to find opportunity because valuations are a bit depressed, but trying to find international growth is definitely going to be challenging. Finding international core is a little bit more reasonable. And then I would also say that in terms of how are we finding that opportunity in the US when valuations are so high, one of the things we tend to look at a bit more can be smalls because those tend to be these companies that start off as providing this sort of mission critical software a lot of the times. Occasionally, it can be hardware in like medical device and things like that. And you don't know about them. You just never heard of them really, and they're sort of operating under the radar. And in this environment where smalls have definitely been punished, we tend to find a little bit more opportunity there with valuation. And then additionally, I think your other question, what was you asked something about uh I can't quite remember, but when it comes to what is it? Of course, my brain is just completely
No
fritzing right
worries.
now.
No worries. That
Um, you
happens.
you yeah, you mentioned something about I don't know if it was Nvidia or I know you were talking about Meta a bit, but oh, and Microsoft. When you're looking at a company that can hold its own even outside of this sort of new shiny toy environment, that's one of them, right? And they've been able to um, sit in that sort of mature space for a while and hop in and out between growth and core with pretty incredible finesse, right? And when they do sort of disappoint a bit, it doesn't tank the entire stock. And then to your previous points on Apple, is very much sort of a core company at this point, right? They're not showing the market that they want to exhibit any sort of outsized growth. They really are just sort of sitting in their comfortable position. And I think that is interestingly one of the things that sort of separates the companies that get rewarded versus the companies that don't. And getting rewarded by the market doesn't necessarily mean it's attractive to us as investors, right? you can be rewarded for something that we believe is about as, tangible as thin air. And so we could say, no thanks. I'm not willing to just model luck into my evaluation, right? Um, and then when you compare probably, let's say, Google and Meta, what we're really looking at is two advertising platforms, but they're going about it so differently. And we have seen over this past earnings cycle how investors judge what fundamentals they set for the two of them, how they judge them, and how they reward or punish them for failing to or exceeding those goals. So it continues to be really interesting. I think on the whole, the TLDR, if you will, is that we are finding ourselves having to pay a bit more than we would have wanted to pay for companies that are trading at a discount compared to the market. But now I remember what your question was. Where do we go from here? How much more growth is there? We've been asking ourselves that for a long time. And we keep saying, all right, well, which operators do we really believe have the capability to appropriately allocate this capex that they're interested in spending, right? And then we have to take another step down and say, all right, which companies are going to use these applications, right? What are people even doing with all this power? So we start looking at things like the actual spend from these different departments. There's a company I follow that, for legal purposes, is too small for me to mention, but they are involved in like data clean rooms with hyperscalers and indirectly, therefore, in advertising, right? So they're big in like the connected TV space, things like that, basically coming up with pseudonymous identifiers for households and people so that they can connect advertisers and merchants and et cetera. And when they are reporting to us, hey, the spend is not great. The spend environment, we don't love it. When we're hearing those types of things, we have to start pairing them with the fact that, all right, well, if companies are scaling down on what they're paying for software per head, then how do we pair that with all of these new capabilities that everyone wants to put out? Who's going to buy them, right? What is the value proposition? So it's constantly butting those things up against each other. I think the unfortunate truth is that these valuations have got to come down or they have to deliver. The trouble is we don't know when that's going to be. We don't know how much longer people are willing to hold out just for the sake of optimism, versus saying, enough is enough. Let's just go where productivity is. Let's go back to manufacturing. Let's go back to home builders. Let's go back to companies that are just returning shares, returning cash and picking up little companies for acquisition and just kind of minding their business and facing front. It's just a matter of when.
Yeah, no, I agree. And I forgot about Google. The interesting thing about Google, I mean, we're well diversified, even though they have a really broken secondary model. So they'll come up with some cool invention, and then they're incentivized by coming up with inventions. But then the second they'll pull those people out and put them on another team, and they'll put another team in, and they're not incentivized to keep it going. So a lot of the projects just go in the wastebasket,
Yep.
unfortunately. That's more of a cultural issue. But the thing I find with Google interesting is the AI is going to totally kill their advertising model. I mean, if it, I'm a geek in marketing, so I look at all this stuff, and I'm finding it hard to believe why I would use Google ever again once I know how to use AI, because I just ask. It might take me 2 hours to solve a problem with Google searches. It might take me 5 minutes to solve it on AI. Why would I ever Google search something unless it's for a company name, which is what I use it for? Like I need to find a company, I'll do that. Otherwise, and then if I go to Google, I look at the top result and it's an AI result. So anyone who's doing advertising, anyone who's doing SEO or all that stuff, it's useless because number one pick gets 93% of the clicks. So to me, it seems like that model's done. And I wonder how they're going to continue to get growth. And I look at Microsoft, which they had the bomber handicap where hedge fund managers would talk about they assumed he was going to light like $10 billion a year on fire. And that's how they discounted the price and he did. He just routinely make bad decisions. And Adele has done a phenomenal job.
Yeah.
He's done a great job with the company. So I see them as probably like one of the standouts, but they're expensive. Just like you're saying, like So let me ask you this, because small caps are kind of an interesting space. I remember those big charts when I started, the big wall charts, and it would show
Yeah.
like 1900 until like whenever it was today in 2000. And it would show the different assets and show small cap way outperforming every other
Mhm.
asset class. And yet small caps have done nothing for quite some time. And it makes me wonder why and what is going to be the catalyst to turn that area around, because large caps are getting all the attention, small caps are
Mhm.
too small to get money because it'll just totally blow up the price and they can't, you
Mhm.
can't dump all this new
Can't sustain
institutional
it.
money
Yep.
in. So it's more of a system related problem than a stock related problem. But still, I wonder why they're not getting more attention and more growth. So I don't know if you have any thoughts on that.
Yeah, absolutely. And I think one of the reasons that smalls don't get the attention is something that's incredibly surface level, but it's very important, and it's analyst coverage, right? So a lot of the time we will see stocks have some pretty big movement over Morgan Stanley analyst downgrades or JP Morgan analyst leaves as neutral after earnings call. When you're looking at some of our favorite small caps, you will see really no significant sort of like big bank or large research brokerage house coverage, right? So they tend not to be as exciting because the information that you get on them comes from brunt force reading of the filings, from reaching out to IR, from really just having to understand the company on your own. And it's a lot less exciting when you add into the fact that sometimes, depending on what you're looking at, they may not trade very often. It's something that people just aren't hearing about, right? So if we're looking at just retail, getting someone excited about small caps when they're seeing that the volume is pretty low, so they're not sure how much money they want to lock up. When we are looking at the fact that there's a good chunk of, let's say, a medical device that's there. And let's say that the catalyst for this company is this particular product that needs FDA approval. That's a risk that a lot of retail investors tend not to want to take, not in really large amounts. So those are really superficial, but really impactful, we found. And then again, to your point, because we are the institutional investor, if you will, on behalf of our retail customer clients, we have to even think about building our small cap positions slowly, right? So there's only so much capital they can even absorb. Then you put on the real heavyweight of interest rates, and everyone's just been terrified. So
Yeah.
you add that issue on top of it already being an environment that people aren't sure they want to be in. You can't overcrowd it, right? And then you throw on interest rates, and everyone goes, well, now we only have the small caps that are well capitalized, and that takes time to find. Finding the small cap that is actually at the point where they are cash flow positive and they're just small because of the business that they do and not because they're scaling. Finding the small cap that has reached critical mass but not yet maturity, those are the unicorns, right? It's like if this is the spectrum, this is where you're trying to hit. And all of the companies that are down here that are still taking on debt and they are not even at a point where they can really talk about debt service beyond, paying interest, that's who gets clobbered. That is duration sensitive and that drags the index down, but it doesn't make us stop looking because as we started at the top of this hour, it's about the fundamentals. And so you suffer a little bit as a long-term investor. You absolutely suffer. And we never once take for granted our shareholders' patience in that suffering. But, small's a little bit of suffering for hopefully a really big reward. And in many ways, we have seen in our small cap portfolio, we've seen some outperformance just because of the diligence that we've taken. And they pop up. It pops up over, a few months or over the 3 year once you really get out of the worst of the macro situation. And that's what really makes it worth it for us is being able to deliver over the index after some prolonged pain because we took the time to really choose what we feel is best and not necessarily just saying, you know what, like let's play roulette with the Russell 2.
Yeah. No, I agree. I think that's great. Great thought. Well, as we kind of wrap it up here, Shelby, appreciate you coming to the show. Final thoughts you can leave our listeners with, and where can people find more about you?
Absolutely. So my final thought would be it's a great time to be an active stock picker. You might wake up and hear breaking news every single day, but oftentimes that makes for the best environment to be picking and choosing when the market sometimes is focused on a lot of noise. So our team is really excited to be active and to continue to find the best opportunities. And I would encourage those with a long-term outlook and with whatever sort of bucket of your investments that is really got a long time horizon to keep active, and to not necessarily be discouraged about the valuation environment that we're in, but to try and make the best of it. You can find more about me on LinkedIn and Twitter. I don't tweet too much, but my full name, you'll be able to find me, Shelby McFaddin, on either one of those platforms.
Awesome. Well, Shelby, I really appreciate you coming on the show, sharing your thoughts with us. We'll have you back in the future, but yeah, thanks for again for coming on.
Absolutely. Thanks, Kirk. It's great to talk to you.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, that was a great interview with Shelby. Really appreciate her coming on the show. Now we're into the panel portion of the show where we have our very own Barb Freeberg. Hey, Barb.
Good morning, Doug. Hi, Kirk. Happy to be here.
Glad to have you. And we also have our very own Doug Hagren. Hey, Doug.
How you doing, Kirk? And I don't know when this is going to post, but happy post St. Patrick's Day. Nobody is wearing any green anymore, so we've clearly that is passe, been there, done that, moving on. So
Yeah, it's kind of, we could talk about it in the Friday show, but it's kind of a weird St. Patty's Day. I feel like people weren't as festive this year as they normally are. But moving on, there's always Cinco de Mayo, so I'm looking forward to that.
Wait a minute. I had my Shamrock Shake. I'm
Oh,
just putting it out there.
boy.
But,
Now,
I had my Shamrock Shake, so I
but
did my part.
but did they still have the McRib? Because if they didn't, I
The
just
McRib is dead for now.
oh, darn, it was there a couple months ago. I was able
I
to get
know.
my once every 5 year.
You got to catch the McRib while it's there.
That is right. There are websites dedicated to showing people when it is and where it's at. And believe me, I'm all over that sauce, that saucy, oniony, pickly goodness. So, pork fat rules. Let's move on.
all right. Well, diving right in. So, Barb, what were some of your thoughts from the interview?
Well, now it's making me want to take a look at the chart of McDonald's and thinking, you know, I like McDonald's a lot. I would like to look at that stock now that we're all riffing on it.
When the
But
McRib's gone, it's a value stock. Okay, just telling you, get in before that McRib comes back.
okay. But, they have standards that you can count on. You know what you get when you go to McDonald's. Plus, you get a toy with your Happy Meal. Come on. So, anyhow, back to investing. Peter Lynch always said, invest in what you know. And that was many decades ago. Maybe many of you don't even know who Peter Lynch was, but he was the amazing, amazing head honcho at Fidelity Magellan back in last century, and one of the top performing funds, I think, of all time. But anyhow, that's what I want to talk about, stock picking. Is it good? Is it bad? Can we even do it anymore with AI, or is it dead?
Okay, well, we'll definitely get into that. Doug, what were some of your thoughts?
Well, some of the thoughts that came to mind for me, I mean, obviously I agree. I think there's definitely talk to get into around stock picking, but even more kind of granular to that, going back to things that were brought up about passive versus and I think that I'll get into it a little bit more, but I think that from the normal concept of picking, especially if we're taking a value, I think if we get to passive versus active, I think one of the risks that happens with passive is it's automatically driving people into exposure to overvalued stocks. So that's counterintuitive. There's some talk. I think there's some things that we could get into about AI investing and the disruption. Obviously, from my college planning standpoint, I think there's some things there. Housing certainly big impact. We talk about it a lot, and when we speak on Fridays, but I think there's some things we can get into there. And of course, I think in all of this, it's also really important. I mean, there's basically five major risks that people are always facing, which is inflation, longevity, taxes, market volatility. Uh, Without all, all the taxes, I think is a big one people have to think about too when they're talking about stock picking, value picking, because I think where you do that and how you do that really, can raise or lower the drag that people aren't aware of.
Okay, cool. So, Barb, let's get into stock picking. I know you're a former reformed stock picker. So, what are your thoughts about the whole thing? I mean, stock picking sounds great and it's kind of romanticized, but I feel like stock picking's dead. So, I don't know. What are your thoughts?
When I got my MBA about 15 or so years ago, first day of my investments class, the professor said, "Who thinks they can beat the market?" Of course, I was a portfolio manager at the time, and I was a stock picker, and my hand went up. I couldn't beat the markets, and I did pretty well. Some stocks did great and others tanked, like most managers. And the data that she presented, and which I have subsequently confirmed over years, is that only about 30 or so percent every year of actively managed funds beat the indexes. So you're talking 70% of the time the indexes are going to win. So it makes you wonder. And the second part of that is the outperformance by those that are beating the indices. Is it based on luck or skill? Okay, hold that thought for a minute. I'm going to flip over to Eugene Fama, who happens to be an American economist, famous financial guy. Heard him interviewed a couple of weeks ago, and he was asked by the commentator, how long does it take to tell whether someone is a stock picker is just lucky or whether they are really skilled? You know what his answer was? A lifetime. Since that time, although I'll buy a stock here and there, I can't help myself. But since that time, I've gone with personally, and I've gotten out of the portfolio management, just managing some portfolios of my own. Point said, it's really hard to be a stock picker. That doesn't mean that some people are not going to pick some winning stocks once in a while. So it's a tough game to be a stock picker, is all I'm going to say. And now with the advent of AI, Are you smarter than AI? I mean, that's what you really have to ask yourself. Now, I liked what Shelby said, which was, maybe there's a little more wiggle room within the small caps.
Are you smarter than AI? Sounds like the title of a new TV show.
Yeah, a game show.
Yeah,
Look,
are you smarter than a toaster?
I barely struggle beating Celebrity Jeopardy, so, I don't think I'm smarter than AI.
Well, cool. So, Doug, what about you? What are some of your thoughts about stock picking?
Well, I mean, there's no question that the argument exists that active managers still underperform most of the time. I think there's arguments that can be made that one of the reasons that they tend to underperform is I think they try to outsmart themselves. A lot of stock pickers will trade too much. If you're actually, investing with someone that's a picker, a lot of times they charge high fees. And I think that in many cases, they don't optimize for taxes. I think a smart active investor can certainly sidestep all three pitfalls that occur there. Um, I think it's also really important to understand from a different aspect, that there are some other things that come with passive investing that can create a hidden risk multiplier. I think that people don't always recognize. It is generally a rule of thumb that when you are investing, you should be taking a look at where your exposure is, and as things continue to, grow, they eventually get to higher priced earnings. They eventually get to a point in which the momentum or the standard deviations start to get really out there and stretch. And that means that you have a higher probability, whether it's actively being decided or now the computers or AI, you can start to see patterns from the technicals in which that bounces back. The issue is that with, say for the S&P 500 example, that is a market weighted index, which automatically there drives momentum. It becomes almost a momentum weighted type of index. That means adding, counter to typical investing, that means adding more exposure to stocks that have already overperformed. That's why you've had the Mag 7, right? As they continue to grow and they continue to take over more market cap, that also meant that they became a greater and greater amount of the performance of the S&P 500. So in that regard, you're actually getting the most exposure at market peaks to the most overvalued companies exactly at the point in which they are most likely to correct. And so, I think that leads to potentially in many cases, because you hear it all the time, by a lot of investors is, the reason I invest in the S&P 500 is because it's simple, it's inexpensive. I'm getting exposure to 500 stocks, and that's not the case. Especially in that index. Now, other indexes are weighted differently, but when it gives you that maximum exposure to market cycles, it gives you less ability to rebalance. And that has a couple of aspects. Number one is the risk aspect, but I want to talk about it from a tax aspect. I know that a lot of people that listen to this are probably in higher tax brackets, more affluency if you're spending time on this. So what's going on there? Well, passive investors think they're being efficient, okay? But where are they holding that? If they're holding it in a taxable account, the moment you try to sell, you could be sitting on huge embedded capital gains. Stock picking can give you an opportunity to strategically trim positions. It can harvest losses. It can reallocate efficiently. One of the things that you could possibly do that mimics what you might have in an index is direct investing strategy that a high net worth investor might be able to look at that tracks an index, but then allows to optimize for taxes, avoiding capital gains a capital gains time bomb. So ultimately, you can do the math that, where you're holding these investments, whether it's passive or active, that long term, the amount of accumulation in, say, a taxable type of brokerage account is actually going to end up having a smaller amount of accumulated value because of the drag of interest and the drag of capital gains and inefficiency to be able to get out and deleverage those taxes. than you would in maybe a more tax efficient account, whether that's tax deferred or whether or not that's an account that is tax free, like a Roth or even, a qualified account. So I think, index investing may sound simple, but until you realize that you're locked into these huge tax liabilities that you can't unwind efficiently, you may end up giving back a lot of the gains that you've accumulated to the federal government to spend how they wish. So I think that's something to add in there, that you can be efficient in how you do stock picking. Now fundamentals, that's tough for a lot of people, so I'm not necessarily saying that you're going to go out there and understand how to pick value investing. Even if you're doing technical investing, I think that, or whether or not you're even just trying to mimic or direct invest, there are ways in which taxes need to be taken into consideration in how you approach that create a wealth transfer and a drag in the long term that most people don't plan for.
Yeah, I appreciate that. So I actually want to break apart one of these Wall Street myths right here. We don't talk about it enough in the show, but I do want to mention it. Is a lot of people, Barb mentioned that, indexes outperform active managers. And that's kind of been this trope people have been pushing out there for a long time. This actually falls in the half-truth category because while in a sense it's true, but it's not the whole truth. So first of all, you have people like Peter Lynch in the past who did beat the index consistently, and you have quite a few managers that consistently beat it. There are not many, but there are definitely some. Here's the problem. So the markets have changed dramatically in the last 40 years, and we're not in our grandfather's stock market. So trying hard not to segue this and make Barb look bad, but when Barb was a stock picker, I didn't mean to call you a grandmother, but when Barb was a stock picker, things were different. Like in the last 20 years, it is not paid to be a stock picker. But in the 90s it did. In the 80s it did. Probably the 70s, 60s, I don't know. I don't have that reference. But basically prior to the 2000s, it made you could be a stock picker. And there were people like Peter Lynch who did a very good job at it. Here's the problem. Here's why it's a half truth that indexing is better than active stock picking. So if you look at Wall Street is run by money and incentives. So if your incentive is, you think about an active fund manager. If I'm a mutual fund manager, let's say a large cap growth manager, my incentive is to hug the index because if I hug the index, I'm with the herd. I'm with everyone else, right? And I'm getting a similar performance to the index. I won't get fired for that. If I'm just hugging the index, I'm not going to get fired for that. But let's say I try to beat the index handily. Let's say I'm like, I want to beat it by 10%. If I do that, I might get a small bonus, like inconsequentially small bonus. But if I get blown out by 10%, I lose my job. So on the one hand, small bonus, pat in the back, a little bit of recognition. On the downside, I lose my job, which is a very, cushy job, right? You're making a lot of money to be a portfolio manager, and you can stay there for decades, just keep doing the same thing over and over again. It's a comfortable job. I know a few friends of mine who did that at some of these big companies. They just comfortably just wrote it out, made lots of money, and then left. Their job was not to blow out the index. It's not. And what happened in 2008, a lot of active fund managers realized how precarious their situation was. Value managers were buying Countrywide and what was the other one? The big mortgage company that got blown up. I forget the name of it, but there were two big.
Wachovia was big in that too.
No, not them. They were this. They're no longer around. They were the biggest. Countrywide was the second biggest. They were the biggest. Washington Mutual, I think it was. Yeah, was it?
Yes, I think you're right.
WAMU. Yeah, so Washington Mutual, they got blown up. They were the biggest. And all these fund managers, these value managers, like, oh my God, they're down 50%. Let's buy it. It's so cheap. And then they buy it and it went to zero, right? So same thing with Enron. Oh, look, Enron's cheap. It kept going down. So the challenge that these people realized in 2008 is everything went down 60%, like 58.6% was the average index return. So if, everyone got blown up. So what they realized really quickly was there's no incentive for picking stocks. So what a lot of them did in 2009 was they were buying the SPY in their mutual fund, trying to index hug. which is absurd. You're not paying somebody 1% so they could buy an ETF in their mutual fund. But they were doing it because they were trying to index hug. Subsequently, they've changed it around. So now they hide that. They don't buy ETFs, but they just buy the stocks, but they're trying to index hug. So their incentives are stay with the herd, index hug. You're going to get similar returns to the index. Maybe you beat it by 1% or lose by 1%, but that's okay. That's your job, is you're trying to index hug. So what inevitably happens when you index hug? Let's say you mark the S&P on the dot. The S&P gets 20%, you get 20%, you're a hero. What happens? But you still charge fees. So now you charge 1% fees. So now you underperform the index by 1%. So inevitably, because of incentives, all these active managers underperform their index. It's not because they're bad at their job. It's because the incentives are lined up for them to index hug. And if they're index hugging, they're going to underperform by their fees naturally. That's why it happens. It's not because they're bad. It's because there's no incentive for them out to perform anymore. That's the reason. There's multiple reasons. That's one of the reasons. And it's a big reason. I've talked to a lot of these fund managers and they'll tell me flat out, maybe not in public, but over a beer, they'll tell me like, yeah, I'm incentivized to just hug the index. So, that's the reality that they live with. So all these indexers that run around saying, oh, indexing's the best. I'm like, yeah, sort of. I'm not sure if it's the best. I mean, there's nothing wrong with it. I mean, indexing's great. We do it sometimes too. But the point is don't think that don't just bow to the god of indexing because you think that indexing's the best thing since sliced bread. It is currently for a very good reason, but there may be a time where it's not. For example, the Mag 7 make up 40% of the returns of the S&P 500. Seven stocks make up the return 40% of the returns of the S&P 500. Is that indexing? Not really. I mean, I guess technically it is, but what if those 7 stocks, go to crap, and all of a sudden the index is down 30% because of 7 stocks? That could happen. They all went to zero. The index would be down 40% if everything else stayed flat. That's not healthy. It's not going to happen, but it could. But they could certainly do poorly. And now all of a sudden the index is not doing very well. Well, all these other managers that aren't buying the Mag 7, all of a sudden now they're outperforming. So is it really the best solution? It used to be. I don't know if it is anymore, but it's what we got and it's what everybody looks at. So I'm not trying to be a wet blanket. I'm just calling it out what it is. It's not the best solution, but it's the only solution we use. So maybe we should look at equal weight indexing. Maybe that's a better solution. I don't know. I don't know. These companies like S&P and S&P Global, and they get paid a lot of money to put together indexes. So who am I to judge? But the point being is you have to understand the why behind these things. Don't just blindly go in and say, "Oh, I'm an indexer. I'm doing great." Just understand the why. And if you still want to be an indexer, that's okay. But if you don't understand why it's appropriate and why it's working, you could end up losing a lot of money because you don't understand why things work. So, I don't know. Anyone got any comments on this, Barb? Doug? I know Doug's always got comments.
Yeah.
I got a comment, but I'll let Barb go first.
Yeah, I do have a comment. First of all, I mean, I think a portion of that is accurate. It's not the whole story, but sure, there's some veracity to that. There's another part of veracity, which is those really super successful investors. Maybe they're not fund managers, but they're private managers. If you're really, really successful stock picker, you may not want to broadcast it. You may not want to let it out. So you've got to also look at the pool who you're comparing. 2 other points, equal weight versus market cap weight. Market cap weight, as we were discussing, is the most popular way to index. That means the biggest companies take up the biggest portion of your investment. Equal weight, like RSP, weights all companies equally. Now, with the outperformance of the top 7 stocks, obviously, equal weight has done a lot worse in terms of returns. But over history, it gives at least every company within the index a fair shot It is more value weighted and is another way to go. I do want to transverse, though, into valuations because we've had a little bit of a dip here in March. And I say little because it is little. Look at the charts, people. This is like, so we're down 4% or what over the year. We're still above the lows of last year. And by using the metric of the price earnings ratio, $1 of earnings is how much the price you pay for the stock. We are way overvalued historically, 40 to 50%. So it causes me to think, because I have don't sugarcoat it, Kirk. I've been in the markets a long time, more than 3 decades. Okay. Do the math. So
Barb started when she was 4.
yes,
Yeah.
I did.
She's an early bird.
I was playing with the stock market game in my crib. But every time the markets have gotten way overvalued, at some point they come down. The problem is we don't know when. The market has been overvalued for so freaking long. Many people who are investors today have never even seen a legitimate down market. But my point is, markets are volatile. That is, you get volatility in order, you're willing to accept volatility because the returns in general are very, very good. But all of you out there, and I'm not like, oh, the sky's falling, but like at some point we're going to get a real decline. I mean, asset prices cannot go on forever being so unhinged from their intrinsic value. And I just say, those of you that are in 100% stocks because you think that's the only place to be, might want to look at some historical pricing charts.
Yeah, no, there's a point you made, Barb, which I thought was interesting, which is the market cap, and I think there's a lot of truth to that. I mean, if you're a small cap or micro cap manager, there's like an art to playing the game, which when I started wasn't. When I started, it was different, and probably when you were stock picking was different too, where you could pick like small caps. Oh, router crash. Okay, so Doug will be back. Um, so, I remember when I was starting, like you could be a stock picker. You could be a small cap stock picker and do very well. And actually some of the best performing funds, I think in 99 were like small caps. And nowadays you've got to manage the flow because if your fund's too big, you can't invest in stocks because you move the company too much. But yet, if no one knows about it, like microcaps, if no one knows about it, then you can't move the company up. So it's like you could buy this stock and it could grow at 20% a year, and the stock price doesn't move for 10 years because no one knows about it and no one's buying it, not because it's a bad stock, but because there's no institutional money. So it gets into this game, which hedge funds actually do, which is trying to manage the information flow. So it's kind of like, I don't know if what are those? It's kind of like watching the movie Wall Street, right? You watch the movie Wall Street and you see like, all right, you buy a bunch of stuff, then you give a taste out to your friends. Remember Bud Fox, Gordon Gekko was talking and he's like, yeah, give a taste out to your friends. You give your friends out, and then you call this number and you say Blue Horseshoe loves Anacott Steel, and all of a sudden it blows up and it's on the front page news. And there's an element to that used to happen because this was back in the 80s where that movie came out. So this was like 4 decades ago, and it's probably happened before that. Now they just have different systems to do that, but it's a lot harder because the information flow is a lot bigger. So I totally agree. I think there's a lot of pieces to this that have to be navigated. But I do want to ask Barb because you brought up this before about AI. So being a stock picker now, in my opinion, is very hard. And I love that we have somebody on like Shelby to talk about it. Because I know she dives in the weeds, and every once in a while I try to bring on like a fundamental analyst and stock picker who's good at it because it is a lost art, and it's becoming a lost art because there's no incentive. You just buy 7 stocks and that's all you need to know. You don't need to know anything else, and it's not the right incentive that we should be setting up in the markets, but unfortunately it is what we have. and so I'm curious to see where that's going to go because there's a lot of good value investors that are just like just like watching paint dry because the market's not rewarding their good intuition. But tell me this, Barb. I know Doug's trying to get back on here at a router crash. What are your thoughts on AI? How's AI going to impact stock picking in the stock market now and moving forward, do you think?
I can't imagine that it would not have a huge impact because if you're a fundamental investor, your job is to analyze a lot of fundamental information. Now, one thing Shelby mentioned that maybe AI can do, I'm not sure, but part of what I used to do is when I listened to the earnings calls and I read the financial reports, I tried to really delve into what are the growth drivers. So there was a certain part of my own thinking that would put together all this information and say, given what's going on in the world, can this company continue to deliver or deliver even in a greater way? And that's the only area that I question whether AI can do that or not, kind of the prediction model. Everything else, they can crunch the data better than you or I ever will. If you're a fundamental investor, if you're a technical investor, yeah, you just plug in the algorithm and they will give you the stocks that meet the criteria. So I would say if I were a gambling gal, that 9 times out of 10, AI is going to be better than an individual stock picker. But maybe in that 1 out of 10 times, when you can really live in the world, see what's going on in the world, you might be able to beat AI.
So here's an interesting thought. I always kind of come back to like the philosophical part about this with AI because I don't know if you ever heard the phrase like if you could see the future, you would change it. Like just by seeing the future, you would change the future because you would change your, let's say, is this person going to cross the street? And then they do. And I knew that I might change my behavior around that. Well, now I've changed the future, right? There's something I've changed now changes what the future could be because I know the future. So you get into this like reinforcement loop, which I find fascinating. So if you think about it, so AI, so if you think about stock picking, right? Um, if everybody's a perfect stock picker, then you'll never find bargains, right? So if everyone had perfect information, so you think about economics 101, right? It's all about, if everyone had perfect information, which in a classroom, that's great in a classroom, but in reality that doesn't happen. Nobody has perfect information. There's always people who have more and some people have less. But let's just say that happened. Let's say everybody's using AI and everybody had perfect information. Then everyone's picking the same stuff, which means there's no bargains ever because it can't happen because someone will buy it. And so we have this perfect market, which effectively, maybe that's a good thing, where it all kind of grows at the rate it's supposed to grow and there's no risk, but then there's no upside and downside. You're basically just putting it in saying, all right, I know I'm going to get 8% this year because that's what the market does. Maybe that's a better path. I don't know. But to me, it seems like you're taking all of the arbitrage, all of the art of stock picking out of the market because AI will find all of those bargains. So I'm not saying it's good or bad. I think it's an interesting philosophical thought process of like, if everyone has all the answers, is it going to work well or not? Maybe it causes a bigger crash. Maybe it causes the markets to be perfectly efficient and and you just buy all the best stocks. So I don't know. It's a quandary. I think it'll be interesting for sure. And I know people are using it. I'm not sure if it's really ready for prime time because I haven't seen anyone using it in prime time. But I'm sure there's hedge funds playing around with it in the background. I can guarantee that's happening. Um, I'm just not sure if that's. I don't think anyone trusts it enough to give it the reins, but I think people are probably using it for research. So I don't know. I mean, it's an interesting thought. I'm very curious about where that's going to end up going. If that will completely change. I mean, because right now the markets are broken, in my opinion. They're completely broken when you have seven stocks. I mean, if you look at it internationally, that's actually commonplace where a handful of stocks control most of the market cap. That's actually we're an outlier up until recently. So I don't know. I'm not sure where that's going to go, but we'll wrap it up here in the interest of time. So Barb, final thoughts, and where can people find more about you?
Final thoughts. The future is unknowable. And although we have frequently used the past to help us determine where markets are going in the future, that may be a little less reliable now, given that our technology is changing so rapidly, especially with the advent of AI. So I would say now it is even more important than at any other time in the past. Do not put all your eggs in one basket, because if that basket crashes, you're going to be really sorry. My name is Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance and also on YouTube.
Great. Thanks for coming on, Barb. We lost Doug, so I'll just tell everybody just with Doug, Doug is an expert in college planning. I can't do his outtake as good as him, but I'll just say if you're looking at sending your kid to college, if you're looking to save money on the cost of college, not save money on for college, not like 529s and all that garbage. I'm talking about save on the cost of college. So instead of paying, 100 grand a year, maybe you only pay 50. And Doug is great at that. So check him out, and we'll put that in the show notes. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.